I really wanted to like this project, but after reading every single page of their docs, I'm a little bit unconvinced. My issue with Ethena is that while they're an absolutely smart and interesting new way of structuring a token, they're definitely not a solution to all of stablecoin problems. They're replacing existing risks with new ones. Also, how can you say you're not a stablecoin and then say you're solving the stablecoin trilemma? Matcha Dex Aggregator finds you the best prices in DeFi. Soroban is a developer-friendly, Rust-based smart contracts platform designed for scale and sensibility. More on them later in the show. Hi everyone, welcome to Crypto with Cami, where we go through all the main headlines in crypto and DeFi in the past week in 30 minutes or less. This is the show for the week starting February 19th. So Ethena is a new stablecoin. It's made a huge splash by claiming it can offer a 27% yield. ETH crossed 3K for the first time since April 2022, and WorldCoin continues to rally. There was more Starknet Airdrop drama. Talking about airdrops, Optimism distributed 40 million of OP tokens to artists and creators, while Aave announced incentives and more. But let's start with Ethena. Ethena burst into the scene with a $14 million seed round led by Dragonfly and a 27% yield on its US dollar-based stablecoin. Naturally, many were quick to ask where the yield came from, and there was a lot of scrutiny of the risks involved. So being a contrarian, I really wanted to like this project. But after reading every single page of their docs, I'm a little bit unconvinced. Let me take you through the very basics of how this novel stablecoin works. But to get the first thing out of the way is that Ethena and its investors say that it's not actually a stablecoin, but a synthetic dollar. In my mind, there is no doubt this is in fact a stablecoin. It has a complex mechanism designed for it to maintain its peg at 1-to-1 with the US dollar. That's a stablecoin. Okay. So, according to their docs, they want to be a crypto-native solution for money that's not reliant on the traditional banking system infrastructure and a globally accessible dollar-denominated savings instrument. Okay, so they claim to be the internet bond, the first globally accessible and censorship-resistant fixed income instrument, which is a very bold claim to make. They also claim to solve the stablecoin trilemma, where they can be censorship-resistant, scalable, and stable all at the same time. And I'll tell you later why I have issues with both of these claims, being the first internet bond and saying they're solving the stablecoin trilemma. Also, how can you say you're not a stablecoin and then say you're solving the stablecoin trilemma? Anyways, as I said, it is a stablecoin. Before we get into the details of how it works, let's go through the problems they see with existing stablecoins. First is centralized stablecoins such as USDC or USDT, and they provide stability and capital efficiency, but they introduce unhedgeable custodial risk with assets held in regulated bank accounts which are prone to censorship, a critical reliance in the existing banking infrastructure, and what they call a return-free risk, which they mean to say that the stablecoin issuer keeps all the yield from treasuries and other yield-bearing instruments they hold, while the stablecoin holder doesn't see any of those returns, and they are still assuming the risk of a DPEG. So that's centralized stablecoins. Now, the problem they see with decentralized stablecoins is that they have historically experienced under a number of issues relating to scalability, mechanism design, and lack of embedded yield. So over-collateralized stablecoins like DAI, FRAX, and LUSD have historically experienced issues scaling as their growth is tied to the growth of Ethereum. And then algorithmic stablecoins have faced challenges with their design, which have been found to be inherently fragile. And then other delta-neutral synthetic dollars, which is what Ethena's USDe is, have struggled to scale due to a critical reliance on decentralized trading venues that lack sufficient liquidity. Ethena says they can solve for all of these problems with centralized and decentralized stablecoins. And here's how they want to do this. They say USDe peg stability is ensured through the use of delta hedging derivatives positions against protocol-held collateral. That's a mouthful, I should say. So what does it mean? Each $1 worth of USDe is backed with $1 worth of staked ETH. This is different from other ETH-backed stablecoins as it's not over-collateralized. DAI, for example, requires ETH collateral worth more than 150% of the stablecoin it's backing. This makes over-collateralized stablecoins inefficient because you need to have more money locked up than what you're issuing. So what happens with ETH volatility that's backing those stablecoins? ETH is the opposite of stable, of course, so any stablecoin backed at just 1-to-1 with ETH would easily lose its peg. Ethena has a very clever way of solving this. For every ETH backing USDe, they open an equivalent short position. That means that the short position Ethena takes will offset any direction that ETH moves. This is what's called a delta neutral position. And where it gets even better is that Ethena will be paid to take that short position. That's because there's usually more demand to go long or to bet for the price of ETH to go up. So traders going long will pay short sellers like Ethena who are taking the opposite bet to borrow their ETH. So Ethena will get yield from its short position, and they'll also get additional yield because remember, they're taking staked ETH as collateral, not just ETH. So these tokens are earning yield from the Ethereum network. Right now, that combination of yield is 27%. Actually 24% right now. It was 27% when they first announced it. So that's great, but some crypto traders have learned, especially after Terra, that there's no such thing as a free lunch. So as soon as we see 20 plus yield, eyebrows go up, and rightfully so. A few additional key pieces to complete the USDe puzzle. One, right now Ethena is only using Lido staked ETH, no other LSTs as collateral. Two, users need to stake their USDe to earn yield. They get a token called SUSDe in exchange. Ethena also has an insurance fund of 10 million in case funding rates go negative or staked ETH depegs. Also, it opens short positions on centralized exchanges like BitMEX and Binance. And finally, it custodies user funds in what are called off-exchange settlement providers, entities like Fireblocks. Okay, so after taking all of that into account, my issue with Ethena is that while they're an absolutely smart and interesting new way of structuring a token, they're definitely not a solution to all of stablecoin problems. They're not a panacea. They're replacing existing risks with new ones. Let's take a look at the claims they make. They say they're censorship resistant. Actually, no, because they rely on centralized exchanges to take their short positions and on centralized custodians to custody part of user funds. All of those can be censored. Okay, they say they're scalable. Not really. They're more scalable than over-collateralized stablecoin, sure. But USDe also ultimately depends on staked ETH. And not all staked ETH, just Lido staked ETH. Right now, there's 30 million of staked ETH total. That's about $90 billion. Even if all of staked ETH was used in Ethena, which right now, again, is not even possible because it's just taking Lido staked ETH, and it's unlikely that all of staked ETH would go to Ethena, but even if that happened, that would still make it smaller than Tether, which has a market cap of $97 billion. They do say they plan to add other types of crypto collateral, but just like DAI, they'll find that crypto collateral ceiling is reached very quickly, which is why DAI started incorporating USDC, real-world assets, and other types of collateral. Okay, now, the most important point for a stablecoin, arguably, the first thing they need to be is stable. And in the case of USDe, stability can happen when at least two important conditions are met. If funding rates don't go negative for a prolonged period of time, and if staked ETH doesn't significantly depeg. Now, as they point out, historically, funding rates have been positive because there's been more demand to go long ETH than to go short. But that doesn't take into account what happens if Ethena steps in and provides constant shorting pressure. If funding rates go negative, maybe at first that can be covered with the insurance fund. But what happens if and when that runs out? Then negative rates start to eat into Ethena's collateral, and it would lead to a potential slow bleeding out of the USDe peg. Negative rates will have to be passed down to USDe holders, which means that more people will redeem USDe. Eventually, there's less USDe, there's less demand to short, and maybe, the stablecoin will go back to peg, provided confidence is not completely lost. So while it's a smart mechanism, it's certainly prone to instability. Now, the next point is a depeg, and that's the potential to be a lot more dramatic than a slow bleeding out. If something catastrophic happens and staked ETH suddenly loses a significant chunk of its value, USDe holders will want to redeem USDe at the same time that staked ETH collateral that Ethena used to open shorts is wiped out, or at least in part liquidated by centralized exchanges. So this would have all the ingredients for a bank run, where people freak out, rush to withdraw, they take a cut of the price of USDe to get liquidity faster, USDe price goes lower, people freak out more, etc. Granted, chances of a staked ETH depeg are low, but it wouldn't be the first time a huge protocol in crypto gets a bug or an exploit, so not something to entirely rule out. So yes, stability mechanism is novel and smart, but definitely no magic formula. Like I said, it does solve some of the risks and problems of existing stablecoins, but introduces new ones. So finally, I want to come back to the other claim it makes, that it's the first globally accessible and censorship-resistant fixed income instrument. What about ETH? ETH, which anyone can permissionlessly stake and get staking rewards in return. That was the first internet bond. Also, the idea of a yield-bearing USD pegged token is far from new. The feature of staking a stablecoin and getting yield was one of the very first features in DeFi. With Aave USDC or Aave DAI, or same in Compound, you could do that back in 2019. Ondo right now offers treasury yield with USDY. So I think a lot of the criticism of Ethena comes from the very bold claims it makes. I think it would be better and safer, especially since it's a financial instrument, if it acknowledged its many risks and shortcomings. Even in the section of their docs, where they talk about risks, they spend time explaining why the risks they list are actually not risks. So in this case, I think a bit more caution and humility will go a long way. Make your trades go further with Matcha, the DEX aggregator from 0x. Get the best prices on swaps with smart order routing and over 5 million tokens at your fingertips. Tap into more than 120 DEXs at once for the best value in DeFi and trade cross-chain for free across 7 networks. And with Matcha Auto, MEV protection will save you money as your trades settle quicker through private market makers. Trade on Matcha today.
If you haven't already considered building your next smart contract in Rust, you gotta have a look at Sorabon. You can migrate your existing Solidity smart contracts over to Sorabon, and we'll show you how. You can also get funding for your projects. There's a $100 million adoption fund just to drive the adoption of Sorabon, so you can help build the ecosystem and potentially qualify for grant awards up to $150,000. You can visit us now at sorabon.stellar.org to learn more.
Now, on to other headlines. ETH pushed past 3,000 for the first time since April 2022, and Bitcoin surged to 52,900, but both have reversed lower. ETH burn rate is surging, indicating a spike in Ethereum on-chain activity. The circulating supply of ETH is at a new post-merge low after a recent jump in gas fees pushed Ethereum's burn rate. While more than 1.05 million ETH has entered supply as reward for stakers since the merge, Ethereum's burn mechanism has permanently destroyed more than 1.4 million. So the recent spike in transaction fees follows an uptick in DEX trade volumes amid bullish momentum in crypto and an increase in NFT sales. Also in markets, the WorldCoin rally continues. It just keeps making new highs. It touched a record of $9 today, February 23rd. And it's not just price. WorldCoin has said their app is consistently posting new user highs since November. WorldCoin's recent momentum is being attributed to the launch of Sora, the new text-to-video AI model from OpenAI. And as a reminder, Sam Altman, the CEO of OpenAI, is also the co-founder of WorldCoin. Also a reminder to watch our podcast with WorldCoin co-founder Alex Blania. It's a great one. Another token that rallied this week is Filecoin's FIL token, jumped 17% in 3 days after announcing an integration with Solana. So the decentralized file storage network said it would host Solana's block history moving forward. The move allows Solana-based ecosystem and infrastructure projects to move away from centralized data storage solutions. There was more Starkware airdrop drama. As you know, Starkware airdropped its STRK token last week to become the largest airdrop ever at 2 billion in tokens distributed. As we've reported, users were less than happy with the criteria to qualify for the airdrop, as Ethereum stakers and developers were prioritized over users of the network. There was such a huge backlash that the Starkware team had to backtrack on some of its decisions. They slightly tweaked the airdrop criteria, but it was definitely not enough to really appease the community. And they also revised the token emission schedule. So now only 0.64% of the token supply will unlock to the project's team and investors on April 14, as opposed to the planned 13.4%. Optimism distributed 40 million to artists and creators. It was the fourth airdrop from the second largest layer 2. They distributed OP tokens to almost 23,000 addresses. Aave is proposing an incentive program. They want to launch a $5 million program. The airdrop would reward users with wrapped ETH and Aave's native Go stablecoin for behavior deemed to be aligned with Aave's strategic objectives. Uniswap launched V2 across 6 new chains. In a surprise move, Uniswap launched its older V2 iteration across multiple chains, despite the fact that it's about to launch its 4th version later this year. Uniswap V2 rolled out across Arbitrum, Optimism, Base, Polygon, BNB, and Avalanche. Each network already supports V3, but the team said V2 offers benefits because it's more simple for to issue tokens and to become an LP on its pools. Leverage is coming to liquid restaking with Gearbox. Gearbox is the first decentralized finance protocol to add leverage into the Ethereum liquid restaking trade. It pulled in over 2,600 of liquid restaking token WEETH, or almost 8 million in just under 24 hours after announcing their launch. I will rush through the next set of headlines. Ondo is bringing its treasury-backed stablecoin to Aptos. Euler Finance wants a redemption arc with its V2 deployment. Remember, this is the protocol that was wrecked by a 9-figure exploit last year. It's hoping to rise from the ashes with the launch of its V2, which it describes as a modular lending protocol. So super interesting. And ending on a fun note, the Chiliz chain is onboarding Paris Saint-Germain, the soccer or football club winner of 9 of the past 11 French soccer championships, and they're onboarding them as a validator in its chain. So probably the first football team to become a blockchain validator. So that's it. That's all for this week. Thank you for joining me. Hope you found this helpful. Please like, subscribe, recommend, and leave me your comments. What did you think of Ethena? What did you think of any of the other headlines we covered? See you next week.